Let's get started. As I said, my name's Luke Laretive. For those who don't know me, I'm one of the co-founders and directors here at Seneca. Here with Ben today, co-portfolio manager on the large cap and small cap funds that we run. For those who are new or here for the first time, we run these once a quarter, about 4 weeks after the end of the quarter. We're a little bit late this month because of the Easter and Anzac Day weekends. It's really just an opportunity for clients and people interested in our business and what we're doing to ask a few questions, gain a bit of insight into the decisions we've made during the quarter. And it's a fairly informal session. You can stick questions in the chat bot. Larissa will stick those up for us, and we'll try and answer those at the appropriate times. We do run a bit of a Q&A at the end, so if you want to save questions for the end, that's also fine. No stress. And as Ben mentioned, this is a recorded session and will go on the internet, so be nice to us. All right. Everything we're going to talk about today is governed by the investment committee. There's 5 of us on there, JB and myself, as well as 3 sort of expert independents. While Ben and I might be responsible for making the security selection decisions in the direct portfolios, we're challenged every month by the investment committee to explain our decisions, to articulate our strategies and support those strategies with data and empirical evidence. And that data and rationale and strategy is sort of monitored over time. So it's a pretty comprehensive overview process and governance process, and something we work really hard on at Seneca to get right. For those who aren't sort of familiar with our business and maybe are here for the first time, we do run 2 direct investment products. One's the Seneca Australian Shares SMA. That's 20 to 50 companies from inside the ASX 300. And we also run the Seneca Australian Small Companies Fund, which is a little bit newer. It's open to wholesale investors only. It's got up to 50 ASX listed companies in there, but they're of all shapes and sizes. So everything from a $5 million market cap, micro cap, all the way up to anything that we want to own in the top 20. So it's a much more open mandate, and it's really designed to generate the best returns we can do. But it does have a bit more volatility. And then outside of that, outside of our areas of, I suppose, direct stock picking expertise, we run multi-manager SMAs, separately managed accounts. It's the global equity strategy, the Aussie equity strategy, the 2 fixed income strategies, and the absolute return strategy. So we're going to go through all 7 of these today. As I said, the investment committee kind of oversees and manages all of that, but particularly the multi-manager SMAs. Aussie Shares SMA, been a bit of a tough quarter, I suppose, with risk-off sentiment, tough market conditions for active managers. I'll spare you the spiel about CBA being 11% of the index and having no growth and being the most expensive bank in the world. You've probably heard it from me and others before. Our performance has kind of been okay relative to peers, and to be honest, the best performing active managers over the last really 24 months have been the ones with the lowest tracking error and the closest to index. So we think it's pretty academically disingenuous for us to charge you guys to run a bottom-up fundamental active portfolio, but just give you an index proxy. So, we're not going to do that. We're going to stick to our process, a process that served us pretty well until about June last year, and been a pretty consistent outperformer up to that time. So, we fully expect that to return, and we've had a pretty reasonable April, and certainly starting to grind our way back. Main inclusions or main buys, I suppose, for the month were to do with, I suppose, our new expanded mandate to ASX 300. It was an ASX 200 product last year and in previous years, so we're kind of incorporating some of those names that are, smaller market caps, got a bit more growth potential, a little bit more exciting, and that's come at the cost of some larger cap, essentially, more boring names that maybe don't have as much growth, or just some profit taking, or rotating out of some of the things that have done okay for us. The Great Takeover, Hub 24 getting really expensive, those kind of things. This month, I just wanted to touch on one new company in the portfolio. It's not new for small cap investors, but it is new for the Australian Shares SMA portfolio investors, and that's Australian Finance Group, AFG. It's about a 500 mil market cap. We met with the management during the quarter. and they're Australia's largest mortgage aggregator and mortgage broking business, essentially. They've also got their own mortgage book now, the AFG Securities business, which we're particularly interested in because it runs on about 8 times the margins of the rest of the business. They had lodgements up 20% versus the previous half at their last report. Their business is growing really steadily or really well. The business is still cheap, it's only trading on 12 times earnings. It's got a pretty consistent, reliable 8% grossed up dividend yield. And our thesis is quite simple. We think that these high margin products and a continually growing book across their business, it's going to see their net interest margins, go from where they are now at 113 basis points back up to, at least 125, but we think they can go to, 133 or 140 even, beyond where they have averaged over the past. And you can see that in that little chart I put down the bottom there. If that happens, this is going to be a $3 stock. So I actually think this could be one of the best performing stocks inside the ASX 300 over the next 12 months. And is certainly a better alternative to a big four bank, but benefits from the same sort of macro events if we have rate cuts and more money going into property and more credit in the economy more broadly. All right, Benny, I might let you to run the small cap.
Sure. Thanks, Luke. So, yeah, small cap fund continues its really pleasing performance in the quarter, or over the last 6 months. We've generated 12.4% outperformance. 7.5% of that is in the last quarter, which is a really great result in a down market, particularly with the volatility we've had over the last 2 months, where a lot of managers have been down over that period. April, we had another solid month on preliminary numbers. Will be roughly plus 2% net of fees for the month of April. And yeah, we continue to find undervalued opportunities with catalysts to unlock that value across the portfolio. So it's not really been one or two stocks driving that return. You can see there a couple of the contributors and detractors. Obviously, in the quarter, we had February, which is the half-year reporting season. So Energy One, EOL, is one of those companies that reported really well. And then you've also got Antipa Minerals, which is more of a stock-specific thesis, which has benefited from a buoyant gold price, which has been a tailwind for a couple of companies in our portfolio, including Imdex as well, IMD, which is tools and technology provider, exposed to exploration and development drilling. So that's another one that's benefited from that commodity price move. Detractors as well, got Wildcat and Stanmore, which lithium and coal have just been kind of priced in the doldrums, but we still have a pretty positive view on both of those companies. And then James Bay, which has actually recovered quite strongly in April. So all going well in the portfolio. We have made a few changes, just kind of added to a few, again, stock-specific ideas, which we think can kind of generate outperformance regardless of what the broader market's doing. And then you see the changes that we've rotated out of include a couple of those takeover candidates that we've spoken to in the monthly reporting and in past webinars, including De Grey and PointsBet. We'll dive into one of those new additions, being Aquirian, AQM. This is quite a small company. It's a $35 million market cap, tightly held with the founder and his management team owning 33% of the company. This is a really interesting one in the mining services space, particularly in drill and blast. So these guys picked up an explosive manufacturing facility on the cheap off a Japanese conglomerate, Hanwha, who were exiting at the corporate level from Australia. And so they had these 3 facilities. They sold 2 of them to Orica and 1 of them to these guys at Aquirian. It's essentially a management buyout. So the management was running this facility and all have lots of experience in the explosives industry. And the reason why we think this is particularly interesting at the moment is it's the right time in the cycle. So we're seeing obviously a lot of gold mining activity in response to that higher gold price. And also in the iron ore space, where there's obviously all the majors in the Pilbara are producing lots of tons, but really it's the key is that they're going below the water table. So more and more mines are getting, all the shallow stuff is getting mined out, and we're going below the water table, which is really good for these guys, being Aquirian, because they do these emulsion explosives, which are specialist at these wetter environments. So we think there's a couple of key contracting opportunities coming up in the next 2 months. And yeah, we've just put in a chart, which is the valuation sensitivity to increasing capacity or utilization rather at that plant. And so you can see that there's pretty clearly, if they do have a couple of these contract wins, there's substantial upside. And last time they had a modest contract win, the stock was up 40% in a day. So it's one of the near-term catalysts that we think is a really good opportunity for our investors.
Cool. Alrighty. So we're going to cover the SMAs. I might leave you guys to review the benefits of SMA in your own time, or if you want me to send you this slide, I can do that. But I'd encourage anyone who's not using SMAs for their investments at the moment. It's a really good way to get transparency, individualised tax treatment, and flexibility with what you're doing without professional management, most importantly, without some of the hassles that come along with owning a range of managed funds. Aussie equity, we'll go to that one first off. The main two themes here for the month really are our small cap strategies outperform the large cap strategies, and our low tracking error strategies, the ones that are more close to index, RQI in particular, outperformed the high tracking error stuff. So we're always exposed to a bit of both in our portfolios, and the portfolio and the Aussie equity strategy was roughly in line with benchmark for the month. And yeah, so not a lot to talk about there, to be fair. This has 25% allocation to the Seneca Australian Shares SMA, with 75% allocated to other managers. Global equity strategy is probably a really good example of how quickly things can turn. We were, in my words, morons, and everyone else's eyes, morons for being underweight the US and underweight US dollar, US equities and the US dollar. And being overweight emerging markets, and that's cost us returns over the last 2 years. But all of a sudden, now we're geniuses, and we've made up 25% of that underperformance over 2 years in the space of 1 month. So we're up 2.25% against benchmark for the month of March, and I expect that's going to continue in April with the way that global markets have been performing. Our infrastructure and Asian investments did well. The more US-focused parts of our portfolio didn't do as well. But yeah, catching up quickly there to the benchmark. Wouldn't be surprised if we closed even the financial year ahead of benchmark there. So again, just proof that just because you're underperforming doesn't necessarily mean you've got a bad strategy. It's just it hasn't quite worked the way you want it to just yet, and you've got to be wrong for a while before you can be right. Aggressive income. There was a bit of a sell-off around private credit strategies, the listed stuff at the end of the month, which probably makes this look a lot worse than the reality. It was, say, like a Metrics Opportunities Trust, MOT, that was down 7.5% in March just on capital. The income was steady and as expected, but it was then plus 3.5-4% in April. So I think this should probably balance back out. But when we come back next quarter and have a look, we made one change here. We sold out of the Bentham Global Income Fund last quarter, and that Colchester product came in. And that's actually one of our best contributors this quarter. So it's been a good strategy, again, away from the US, adding exposure to emerging markets. And this portfolio is running at about an 8.5% yield at the moment. Defensive income has had another solid quarter, continues to outperform. Again, Colchester was a recent change, and that's performed well for us, as well as mutual high yield's been doing well for a while now. Good strategy that. So this is running at yields of over 7% at the moment, continues to do what it's supposed to do, and delivering for investors essentially. Absolute Returns had a bit of a whippy month with the trend following strategies. They really struggled when the markets aren't trending and we get these up and down periods. So they were hit a bit hard. The hedge fund strategies in this product performed very well. They were plus 2.14% on average. I would like to point to the trail we have on our peer group here, the pink line on the chart, which is the absolute return peer group on FE Analytics. I had a quick look going into this meeting, and it's important to point out that benchmark, or that peer group, has a 60% correlation, or 0.6 R squared, to the MSCI All World Index, the global stock market index, and we only have a 5% correlation. So this absolute return strategy is designed to be a portfolio diversifier, to reduce portfolio volatility, and to add return in times when the markets don't. So it's very uncorrelated to markets, and when markets do rip higher, as they have the last couple of years, it's hard to keep up with that peer group because it is so much more correlated than we are. But we're pretty happy with the strategy. We're looking at a couple of changes here, mainly around some of those trend following strategies, whether we increase our weight now that we think markets have stabilised and the VIX has come back down, or whether in fact we might be better off with some more market exposure at this point. So that was a topic of discussion at investment committee this month, and we've got some research underway around how we're going to best implement some of those conversations that we had at committee meeting. From an outlook perspective, as much as there's a lot going on in the world, it's kind of playing into the way that we think about things and have been thinking about things for a while. Aussie equities are still preferred to global equities, both from a rates and FX perspective. You've got small caps. We think they're going to continue to outperform large caps with lots of opportunities. We're pretty attracted to kind of the mining and pro-cyclical names at the moment relative to some of the really expensive growth that's out there. We're maintaining our overweight to Asia and emerging markets, relative to the US, both across fixed income and equities. We like emerging markets at the moment. We think that's a really a distinct opportunity to add value. We think there's value in fixed income as well. I think bond yields have had a bit of a spike, but they should start to come down now, and that's going to be a capital gain opportunity for bond investors. I think the markets are pricing in near-term rate cuts in most developed markets still, despite the, I suppose, uncertainty that comes from tariffs. The US is probably the exception, which was part of that conversation more recently. I think the Chinese stimulus that's going to come, depending on quantums and scale and how they direct it, could be a real tailwind for commodities, as well as emerging market equities and fixed income. The dollar's low, which is supportive for a lot of our listed companies here. And, we're sort of thinking about the tariffs and what's happening in the US in sort of the relative impact of incremental news. And we think that the incremental news is probably positive relative to where we are now. And what's in the price is significant pessimism. So we're cautiously optimistic at the moment. And it appears that, tariffs are going to continue to get sort of wound back, rolled off and amended to be less of an impact than we first thought and were first announced. So that's pretty much our views at the moment, which gives us, as much, 10, 15 minutes for Q&A.
I'll give you a Dorothy Dixer.
Dorothy Dixer from Benny.
Which is, I feel like a lot of people have been kind of asking over the last few months, given how strong the US market performance has been. The question is always, well, why wouldn't I just put all my money in the US? And why would I even bother looking at kind of other regions? But I think this last kind of quarter has been a good example of why that's.
I think it is a good example, but I think even more so, some of the trends around both money flows. So the US has been, as a percentage of global market cap, has been growing, really strongly on the back of these historical returns. So I think that unwinds and mean reverts over time, and we see emerging markets benefit from that. I think the valuations are pretty compelling for European and emerging market equities, or non-US equities right now, relative to the US. And I also just think that some of the demographic and trends in emerging markets are things you want to have exposure to. I think a lot of people talk about the the views on China and the emerging middle class, but you can make other arguments around parts of South America, India, Indonesia, Vietnam. There's lots of good places to invest that have got good demographic tailwinds. So I'm big on emerging markets. All right, we've got a question. Always like a couple of questions. Have we sold out of PointsBet and Degrade? Yes, we have sold out. So we've taken our money. We think the PointsBet bid from whatever they're calling themselves now, BlueBet, Better, whatever. We think that's pretty fugazi.
So they've got to raise a lot of equity to even compete with the existing bid, which is from a cashed up, large scale Japanese company. So it's not really as attractive. And even if they do get a higher bid, it's unlikely to be material. And I think just with those two, like, mid-month in April, the market was down, or the small odds was down 8%, wasn't it? 7 or 8%?
Yeah, maybe 9 even.
So we don't really want to be selling our quality kind of growth catalyst ideas at the bottom of the market. So what are you going to use as a funding source if you're largely fully invested? Well, some of these, PointsBet was pretty much flat through that period.
The grade was flat.
The grade was flat. So yeah, it's a good funding source as well.
It's been helpful for driving the positive returns we've been able to deliver this month ahead of benchmark. So that's been good. Short, medium-term views on coal and lithium. Well, I think short, medium-term needs to be defined. If you said I would define medium-term as 3 to 5 years, I don't know whether that's what you're after, Chris, but I'm positive on both. I think with coal, you need to be specific, and I think with lithium, you need to be specific. So, are you talking about a hydroxide, plant? Are you talking about a spodumene mine? Are you talking about a brine brine mine? I think all of those prices go up. I don't think there's much incentive for anyone to bring on lithium production, and I think demand looks pretty good. So, that'll sort itself out in due course. Question is when, who knows? I don't know. No one knows. So, giving you a view on that's kind of stupid. Coal markets look really good, and met coal, I think, in particular, starting to find a pretty natural bottom, and I think that market will come back well. Thermal coal I'm actually really bullish on as well. When you've got high gas prices and low oil prices and low coal prices, I think that speaks to there's still energy demand out there. The shift might be changed, the mix might be changing, but I think there is some substitution between those three energy sources, and I think coal looks pretty attractive. Thermal coal looks pretty attractive at the moment as well. So we own Stanmore and New Hope across the business, New Hope for thermal exposure and Stanmore for met coal exposure.
Just on Stanmore, I think it's key when the commodity price is going down to make sure we're invested in companies with good assets and good management teams.
High quality, lots of cash, can make the right decisions without having to be pushed into doing stuff.
Like, even though it's been a detractor, it's outperformed peers pretty significantly. Couple more questions on the resources space.
Hold on, what have we got here? I'm
in the Q&A.
Yeah, the Q&A, okay, sorry. Yeah, use the Q&A, guys, if you can. That makes it easy for us. Cron, do we see BHP improving? Yeah, BHP's fine. I don't really have any issues with that mate.
Like the iron ore price is still $100 a tonne. So
they're still making heaps of money. They've got good free cash flow at these prices. I'd be cautious on getting too gung-ho on it, maybe is probably the right way to describe it. So, I wouldn't be getting too carried away. I don't necessarily think there's huge alpha opportunities, but I think there's relative alpha opportunities to own BHP over other stuff in the index. Any thoughts on gold stocks from JB? Benny, you want to do that one? You're the gold guru.
Well, we did a bit of content on that recently on Livewire, and also in the video series Buy, Hold, Sell on Livewire. So worth going and having a look at some of that stuff that we're doing. We're always pretty active on the content front. But yeah, just briefly on gold, I think it's really been a beneficiary of pretty sustained underinvestment in terms of flows and into the miners themselves over the last couple of years. So partially it's been a bit of a normalisation trade, but also then we've had risk-off sentiment with kind of the Trump tariff drama in the markets over the last month. So people have kind of been extra keen to get some gold exposure, and that's really driven the price higher. So I think the gold stocks themselves, some of the producers look still reasonable value because they're not really pricing in anywhere near the current gold price, but some of them have run quite hard, and I think there's probably a better value in the developer space selectively, where some of these resources are still trading pretty cheap just because it hasn't really fully flowed through to the junior end of the market.
Graham wants to know, do we have any interest in Golden Horse Minerals?
Yeah, there's been a couple of broken notes on that recently. I mean, there's a bunch of these WA developers.
There's so many.
And you can either go for proven in-the-ground resources, or you can go for more speculative upside potential. As we saw in the small cap slide, our preferred option is still Antipa Minerals, because not only do they have a large proven resource, but it's in a really strategic part of the world where there's a larger miner in Greatland Gold, which is highly incentivized to grow their resource base and fill any production gaps in their mine plan. So we think it's got that strategic value and takeover angle. But we're certainly assessing a lot of these opportunities in the junior end.
Someone was just asking about Antipa, but I think you just joined then. Yeah, we still think it's going to get a takeover bid. And yeah, we still think you're underwritten with the resource as it is. They've got heaps of exploration upside. And I think, as I've said publicly, if you're a Greatland Gold shareholder, I'd be lobbying to buy that because it's worth an extra $500 million to your minimum. So, that's before you get the multiple re-rate from a better mine plan. And then Cron's asking, is America being isolated? I don't know. I sat on a meeting, a lunch thing yesterday with a $30 billion fund manager from Singapore who specialises in emerging markets, and we're talking about, is American exceptionalism dead? We don't think so. We just think that it's coming off a bit. So I wouldn't be getting too carried away with motherhood type statements around the US is going to do this, the US is going to do that. I don't think I don't think too much will change, but it might just be a mean reversion. Let's call it that. All right. Any other questions?
Good questions. Appreciate everyone's questions.
Yeah, it's been good. Yeah. All right. Well, look, if there's nothing else from the floor, it's 1:00. We're bang on time. Look, if anything else does come up, I'm sure you've got Ben and my emails, or you can find them on the website. If you want to have a chat, feel free to give us a buzz or drop us an email or whatever. But yeah, look, appreciate everyone coming in and taking the time. It's very nice of you, and we're always shocked that people want to listen to us. So thanks for that, and hope you're getting some good. Enjoy investing with the products, and if you're not invested with us and you want to get invested, please reach out.
There's one more question there.
Is a small cap available in SMA? No, it's not available in SMA. It's only available to wholesale investors, just a direct application, old school. You get a unit price every month.
I've just put a bit of money in this month. I have.
Cheeky.
Which I thought I was going to catch the downturn, but I think there's still plenty of value available. So open to applications and interested in discussing if anyone's interested.
Perfect. Thanks, everyone. Appreciate your time.